Hi, welcome to the WealthFluent Series, your guide to mastering your financial future with cutting-edge tools and clear insights. I'm David Kahn, co-founder and CEO of WealthFluent, a software company that empowers people to take charge of their financial future with an easy-to-use financial decision-making platform. I'm joined today by our chairman, Stanley Kahn, PhD, whose expertise as a finance professor, journal editor, an institutional asset manager powers our mission to put you in control. WealthFluent's philosophy simplifies the complexity of managing your finances through a personalized, holistic wealth management platform. Everything is driven by your unique situation, lifetime goals, and today's market conditions. Today, we're tackling a common rule of thumb, a big question. Does a 60-40 portfolio work for everyone? Down this classic strategy, debunk myths, and show how WealthFluent's philosophy and tools can help you get a personalized wealth portfolio to fit your life. Whether you're planning for retirement, growing your net worth, or navigating major milestones, let's explore how WealthFluent can help you achieve financial freedom. Dr. Khan, say hello.
Hello, everyone. Glad to be here.
Okay, so let's break down this 60-40 portfolio rule of thumb. It refers to, a balanced investment strategy where 60% of your portfolio is in stocks and 40% is in bonds. It's often recommended as a one-size-fits-all approach for individual investors, particularly those with a moderate risk tolerance. Because it aims to balance growth and stability, here's why it's considered to work for everyone. So it's an easy-ish way to get a lot of diversification. If you have 60% stocks, you get growth potential, but you have some pretty reasonable volatility. Stocks will have higher returns over the long term, but risk is pretty high. Now, the bonds offer stability, lower volatility, and steady income through interest payments. They act as a cushion during stock market downturns. This mix reduces all portfolio risk while still capturing growth opportunities. The other thing why people usually choose the 60-40 split is it's designed for investors who want moderate growth without exposing their entire portfolio to full volatility of the stock market. Historically, the allocation has delivered some solid returns with less risk than an all-stock portfolio. For example, we lived through the 2008 financial crisis. Bonds often hold or gain value, offsetting stock losses. So the other part of why so many people recommend the 60-40 is it's simple. It's an easy to implement and maintain, requires minimal financial expertise. Investors can buy, mutual funds or ETFs, like the S&P 500 for the stock, 60%, 40%, and one for bonds, like a total bond market fund. And you rebalance periodically to keep within that 60-40 percentage in your allocation. And that's it. So it's broad. Basically, it suits a wide range of investors, especially those saving for long-term goals like retirement. Is it basically balances the growth for wealth accumulation with stability to protect those gains. It's a middle ground strategy, making it a default choice for those unsure about their risk tolerance or investment preferences. Historically, this worked in a lot of economic climates in the 20th century and beyond. From 1980 to 2020, Vanguard studies show that the 60-40 portfolio averaged an annual return of 8 to 10% with lower volatility than a total all stock portfolio. This strategy worked well in environments where stocks and bonds had a low correlation, meaning bonds often rose or stayed stable when stocks fell. Despite challenges, the 60-40 portfolio remains a solid starting point for many due to its simplicity, reasonable historical performance, and adaptability. You can customize it, within the 60-40 to having, international stocks or, corporate bonds, things like that, based on, changes, but mostly it's a buy and hold strategy. All right. That's the background. That's, typically the way this rule of thumb works. Dr. Khan, what's the problem with this rule? You have thoughts here.
Yes, I do. Let me just start with the idea behind WealthFluent is to bring many of the sophisticated institutional portfolio management techniques to individuals and advisors and planners. The math that usually is a deterrent for most people, it's in the background. What we give is output to evaluate the market in conjunction with all the client or individual or family's preferences. So there's reason this process is suboptimal, and when it may be touted for average performance, it's not the performance you could have. For two reasons: it doesn't include personal characteristics of the investor, and we know the risk aversion of a young person is a lot less than the risk aversion of somebody that's retired. The second important component is it does not concern itself with the composition of the 60% stock subportfolio or the composition of the 40% bond portfolio. It's typically thought of as just a large stock portfolio and a large bond subportfolio. The way you think about valuation is to consider three major characteristics that we do get good information on day to day. Markets are dynamic, so we have to reevaluate the circumstances of new information as we go through the process. The big macro implications for valuation are the current level of interest rates, the slope and trajectory of the yield curve, the treasury yield curve, risk premiums on asset classes, and expected future cash flows to the asset owners. And the risk changes in each of these levels represent a future probability distribution for each of these securities. Well, how do we get these updates? VIX is a well-known indicator of expected volatility and changes in expected risk premiums for the future. So as we saw very recently, a huge increase in volatility from sort of the long-term average of about 17% all the way up to 60. The question is, what does that mean and what are the offsets? So clearly, the uncertainty was huge, so the risk premium rises. But in some environments where there's a flight to quality and people move towards treasury securities, get those prices up and yields down. So that is a nice offset in the valuation process. But there was very little of that in this last round of tariff uncertainty that hit the markets. But tariff uncertainty also had the question of how are expected cash flows to stockholders and bondholders, especially risky bonds, are being affected by the supply chain potential problems. So it's a combination of all three of those and what are the magnitudes of each. So in this last case, it was not interest rate driven, but it was mostly driven by uncertainty and the potential downside risk of lower expected cash flows to asset holders. In another instance, 2022, we had a huge interest rate increase by the Fed. Once the Fed starts moving, no interest rates are going to rise. And you're concerned with which bonds are going to be more sensitive to that rise. Longer term bonds clearly are because they have higher duration and a higher decrease in value for a 1% increase in interest rates. So that was an interest rate driven market. So it affected stocks and bonds the same way. So there was lots of positive correlation. So both of them declined dramatically in 2022. There was no diversification benefit. And when macro factors dominate, you can't get much from additional diversification. You can get something from hedges and dynamic portfolio management. None of that is available with a fixed scenario of both percentages in stocks and percentages in bonds and not changing the underlying composition of each.
So would you say that the whole concept of the low correlation, which meant that you had the extra diversification with the kind of even split bond and stock portfolio, doesn't always work?
Definitely not, because what you're seeing is historical averages. No crisis period as it evolves is the same as previous ones. I just gave you two examples. One is in a very stock risk scenario where risk premiums go up and prices, people move their asset allocation towards treasury bonds. It's called a um, flight to quality. So there's negative correlation, and that's great for diversification. But that's not all the time. This last one, due to the tariff issues, interest rates did not help. There wasn't a big flight to quality. So that was kind of neutral. But in 2022, it went to very high correlation because the level of interest rates and their changes went across all asset classes. What does that tell you? It tells you that the correlation between stocks and bonds is time varying. Sometimes it's negative correlation, sometimes it's positive correlation. And when you use a 20-year period or so to say, oh, it averaged okay, all right? Well, that's not taking advantage of the changing correlations and changing your portfolio composition, not just in the weights from 60/40 to something else, but the composition of the bond portfolio. For example, prior to 2022, we had about a decade or so long of very low interest rates, near zero on the short end of the yield curve. That's why money market funds had zero return for many years. And there were times when the long bond, 30-year treasury was down to 1.5%. Well, people get this feeling I need to make more money. So they go into long term bonds. But when interest rates are so low, the probability of going lower is very small relative to the probability of going higher. So you're making a decision to increase interest rate risk by more than the incremental increase in expected return you're getting. So it's really better to stay short term in money market funds and bonds, maybe up to 2 years of duration, and wait for the increase in rates when you can reinvest quickly as those short term bonds mature and go into higher and higher rates. It's the best hedge against changes in expected inflation.
We saw some big cases of this just a couple years ago. Silicon Valley Bank didn't have a great way of managing their interest rate risk.
Right. Well, individual balance sheets look a lot like those of banks and insurance companies and lots of other institutions, pension management, etc. What you're really looking at and want to manage is net worth, which is assets minus liabilities, where in the case of banks, they invest typically in longer term bonds. essentially. They're loaning money. And Silicon Valley Bank loaned money to a lot of tech companies. So there's no diversification across different sectors. That was bad number one. Bad number two was they financed those loans with short term deposits. So as interest rates rose, their long term portfolio of loans has a roughly fixed rate. So as short term borrowing rates increased, they ended up with negative profits at some point. And the worse that got, the federal government or the regulators for banks, the FDIC, had to come in and take them over because the market value losses were so great. Now, and it was basically mismanaged. But part of the regulator's job, they do require certain risk management that obviously was not watched carefully by the regulator because they didn't have any. So, it's the same kind of balance sheet at a bank as an individual has. Assets minus liabilities means they're managing both the expected future wealth of net worth and the risk of that. So we need to be able to project that future probability distribution of wealth. Expected wealth and standard deviation of wealth for a risk measure is only part of what describes the full distribution when you have the potential to go broke, to go to zero. Okay, so that creates a boundary condition and needs to be part of the view of the entire future. That's what we do at WealthFluent.
So it seems a lot like if the Silicon Valley Bank can't handle it, how interest rate risk, how could individuals? So this a lot of the reason we did WealthFluent and we've got this platform really has to do with the fact that we wanted to bring really powerful tools like the institutional asset managers from our past we did to regular people. Regular people can manage interest rate risks if they have the right tool.
Absolutely. And that has been my practical experience after being a professor. By being director of research and co-director of the investment management group at Smith Breed Associates. And we only manage money pretty much for institutional level clients with the same kind of balance sheet as individuals have. But this kind of technology had never been brought to individual wealth management, and that's our goal. So, getting back a little bit to fixed portfolio strategies, do not adequately respond to changing market conditions, especially for investors with their unique circumstances and objectives. So, to us in the world of fixed income portfolio management, during this decade or so of low interest rates, interest rate risk was so high that we would hedge it out. And essentially, we'd use, let's say, Treasury future short positions to take it out. But for individuals, that's too much to expect them to manage. But they can get the same result if they like what's going on for the risk premium in mortgage markets or corporate bond markets. They can pick those ETFs or mutual funds where the fund does it for them. They're called short duration mortgage strategies or short duration corporate strategies. And you can mix that with short term treasury investments if you wanted to. Also, do what every core bond manager institutionally does, which is they underweight treasuries. Their benchmark is the total bond market of investment grade securities. So they're going to underweight treasuries that have no risk premium. and overweight mortgage and corporates because of their additional risk premium that on average over time they will benefit from in performance without any special information. Now, of course, you might adjust institutionally, you may adjust for when those risk premiums are high or low. Are you getting enough compensation for the risk contained in that risk premium?
So there's a bunch of reasons why the 60/40 portfolio does not work in any changing market situation. And at WealthFluent, we believe that investors should have the tools to be proactive, listen to what the market is telling them, and most importantly, have risk management like the institutional grade asset manager would have at every step in a disciplined wealth management process. So how do we do this so much better, do you think?
Well, let me give you another example. We don't know in advance. We have probability distributions of what might happen in the future, but we don't know exactly what path you're going to take. If you start out and the path is going above what's expected, you're pretty happy. And maybe when you get closer to retirement, you say, what strategy should I use from that point on? I could lock in all those gains and set up a very nice level of withdrawals till the end of retirement. Or I could look more carefully and say, I have way more than enough here for my consumption for the rest of my life. So the difference is I'm actually managing that money for my heirs with a much longer horizon. So I can actually increase risk for their horizon. Secondly, if the path turns out to be ending up lower than expected, well, now I might be getting a little too close to that boundary condition in the future of hitting it. So I may lower my risk dimension for my entire wealth portfolio. So everything is path dependent in your dynamics. Some is from your own personal circumstances and objectives for your future, and some is due to market conditions. So we've just mentioned a few circumstances where you would want to not have own the total bond market, but you would much rather own a short duration or a low interest rate risk bond strategy. And in professional management, cash is really included in your bond strategy or what I call money market fund returns. But here we separated out cash and bonds, meaning longer than 1 year of maturity, so that the individual can see it clearly. And a lot of their movement towards money market funds for fear is really part of their bond portfolio strategy to reduce overall interest rate risk. So, and we can do the same thing on the equity side. Now, it's good to have diversification. Some diversification strategies, when the market is bidding the price up, may have a low expected return. And they do that for a sort of self-insurance. You see that more in the bond market when people want tips, which has an inflation adjustment. And because they're worried about inflation, they pay so much that the real yield, the real return is negative. So, gee, that's not necessarily the best way to hedge that risk. And in stocks, there's this feeling of getting more diversification by going into alternatives and others, strategies, real estate, etc. Well, individuals tend to own real estate if they have a home. They also tend to have things like pension funds, pension, annuities, Social Security. Those are bonds, but and really belong in your bond portfolio, just like a mortgage is a short bond position, borrowing, and moves in the opposite direction of your other bond investments that are long positions. So you need to take all that into account. And that's why you want to be managing net worth.
And that's what we do in WealthFluent.
Absolutely.
So what's great about what we do in WealthFluent is we take the complexity that we talked about in this conversation and the issues you would see with something like a 60/40 portfolio. We give you the power to plan your life, all of the goals, and create an output that is a custom investable portfolio from your planning process that takes into account the complexity, the risk, and is projecting from current market conditions. So this sounds complicated, but we've done a lot of work to make sure that it's something that someone could do themselves or working with someone else who wants to help them. And this is packaged in a easy to use platform that anyone can sign up for today. So, 60/40 is essentially a long-term strategy. It's a lot like the things we've been seeing all over the place from, either big firms, investor notes, or all over social media, is this idea that in the last couple months, we've seen huge volatility. And we've been watching, our VIX indicator and WealthFluent really carefully. So I hear stay the course often. So what do you think about stay the course in relationship to these kind of simplified long-term strategies?
Yes, there are two types of stay the course. One is do nothing, and that has some benefits of saying I can have a floor essentially on my losses. So as stock prices drop, the weight you have in stocks is being reduced and more in low risk fixed income securities will dominate. If the stock's price goes down dramatically, your portfolio will head towards that floor. If, on the other hand, you want to do rebalancing when stock price goes down because risk premiums go up as we observe through VIX, then rebalancing means you have a higher risk strategy for your portfolio than you did beforehand because you're just adding to a new level of higher risk in your equity portfolio. So, well, but in this case, they're doing nothing. It is a decision, but it's more consistent with a downside risk management strategy or what's called portfolio insurance. It's not an exact replication, but it has that tendency. Um, so no matter what, no decision, staying the course is a decision. And but there are the two parts. One is when you do nothing or when you rebalance. And those two methods of staying the course are very different in terms of the risk return trade off you're taking going forward. The other major impact of what's wrong with the strategy of staying the course is dependent on the composition of your bond portfolio and your stock portfolio. Being proactive means that you look at the compensation you're getting for interest rate risk and credit risk and prepayment risk among treasuries, corporates, and mortgages. If you're taking a lot of interest rate risk with very little compensation for increasing that risk going from short to long-term treasuries or other bonds that have higher durations and you're not getting sufficient compensation, and we've had that before 2022 for a decade or so, you should stick with short-term, low duration bond strategies because it was much more likely that interest rates were going to go up than go down. So being proactive says the composition of your bond portfolio should be low risk. And those folks that did that prior to 2022 saved an awful lot of money by not having their bond portfolio drop by 15% when the equities dropped by 20%. That very high correlation provided no diversification if you had a lot of long-term bonds. So proactive there. And in equities, proactive is when VIX is well under its long-term average, risk premiums are very low. So you want to have a lower weight on your equity percentage. And when VIX increases dramatically, you've avoided those losses, but then can restructure to get the much higher risk premium going forward by increasing your weight. Okay. This is not a market timing decision, trying to make changes on a daily, monthly, or quarterly basis. This is what the market is telling you the reward is for taking risk. So don't take risk when the compensation is insufficient, and take risks when it's more than sufficient. All right? That's the way our utility functions or trade-off views are best managed. So some folks will say, okay, well, the 60/40 is okay over time, but it's both inefficient and a low performance strategy if you can use market data most productively.
Yeah, so it seems like we're still finding a lot of holes in the classic 60/40. But, the premise of a simplified, diversification, easy to manage portfolio is still super attractive. So, an easy way to manage the portfolio is the goal. And, people being able to answer, is my asset allocation right for me and my retirement? Should it change at different points in my lifetime? These are the things that we want to solve. And at WealthFluent, we believe in being proactive and listening to what the markets are telling us. We believe you should be able to answer the big questions with all the data and the insights you need to make informed decisions, and for you to be able to actually execute on running that portfolio. So most importantly, risk management has to be embedded at every step of the way.
Typical risk tolerance or risk capacity alone profiles used by many investment firms are insufficient for lifetime wealth portfolio decisions. It is currently used to put clients in a risk bucket without giving them the market's compensation for that risk budget. Where is the risk versus expected return trade-off choice? WealthFluent, on the other hand, has a disciplined net worth process that eliminates behavioral biases, employs auto-updated financial data with innovative financial modeling to have individuals and families make decisions in their own best interest. The implication of that is by having auto-updated components readily available, this allows the user to focus on financial decision making. Users are now proactive rather than reactive to changing economic environments. Lifetime net worth management is a dynamic process, not a fixed lifetime strategy like target date funds that do not adjust for evolving market conditions. Lifetime financial planning and changing expected return versus risk trade-offs in all sectors of the marketplace require simultaneous revision decisions. The effects of changing economic environments are all in market data updates. No special information is required. Only logical interpretation of the data is required. In WealthFluent, this process is provided for in our tool set. WealthFluent provides expected future wealth versus risk trade-offs in conjunction with all goals, savings, spending, commitments to choose from. WealthFluent combines financial planning and wealth management for simultaneous solutions that are in a user's best interest.
Thank you, Dr. Khan. So, what we strive to do and we continue to do is WealthFluent takes, which is complex, simplifies it, and helps you have a dynamic plan. Instead of static strategies like the 60/40 we discussed today, you can have a strategy that changes with the market and changes as your preferences changes over your lifetime. We built these tools to be easy for you to derive that strategy, choose it, and implement it with your own constraints. So thanks again. We'll see you next time. And remember, you can try WealthFluent out for free at wealthfluent.com. That's WealthFluent.com. Thanks, and we'll see you next time.